Good afternoon. Thank you so much for joining us today for our next installment of Startup Fundamentals for Workshop Series. This series is presented by UM Ventures at the University of Maryland and in collaboration with Dingman Center for Entrepreneurship at the Smith School of Business and MTech at the Clark School of Engineering. I'm very happy to welcome to today's recording Joe Bishop, CPA and senior accountant with a very well-known accountant firm, Snyder, Cohn, and Joe can tell you a little bit more about what he does, but he specializes in working with technology startups, and he understands the importance of startup founders having an idea or some sort of early knowledge about what accounting is. And he will walk you through that today, and especially how that relates to startups, because accounting for startups is very different than accounting for large firms. So thank you so much for joining us today. Joe, go ahead, and I'm gonna stop my video and mute my mic, and Joe, you can take the lead. Thank you so much for doing this for us today.
No problem. Thank you for having me. All right, so as Olive said, I am a CPA with Snyder, Cohn. We're an accounting firm in North Bethesda, Maryland. I would say we're mid-sized. We have about 70, 75 employees, and most of our clients are in the DMV area. But with the remote world the way it is now, we have started working with some clients farther across the country. But anyway, while I do a fair number of things at the firm, such as, auditing, tax, consulting, so forth, with a lot of different types of clients, I do have a specialty in working with startups and emerging technology companies, as well as their owners, on various tax and consulting and financial statement issues, and also compliance issues. Lately, that's become a growing area, which we'll talk about in a bit. As we've seen a lot of startup companies applying for federal grants to raise money. And that creates a lot of compliance issues where having a good set of accounting records becomes very important. So really what we're going to talk about today is, I'm sure, everybody's favorite topic, Accounting 101, and just the overall importance of having a good accounting system in place and what it takes to do that, and really just how you can use your accounting system to make various key decisions. So I'll get on with the presentation, but whenever you feel like you have a question, feel free to enter it in the chat, which Al is going to be monitoring, and I am more than happy to answer any questions along the way or at the end whenever you have them. So we'll get going here. The overall objectives, kind of as I just sort of went over, we're going to learn about the purpose of accounting. We're going to talk about the accounting equation and how that can be practically applied. We're going to learn about the various financing options that are out there. Obviously, that's an issue of key importance at the very beginning. Startups need to know how they're going to raise money in order to do what they're going to do. We're going to go over the accounting basics. We're going to talk about the key financial statements, what they look like and how they're used. And if time permits at the end, we'll talk about some key financial statement ratios that lenders or investors might look at when they're looking at your financial statements in order for them to make decisions. So the purpose of accounting, from a very broad perspective, it's to be able to accurately report on the financial information that reflects the company's performance, and to help the individuals who are reading those financial statements make informed decisions. Accounting is necessary in order to accurately keep track of the company's resources and its obligations. And again, if used appropriately, it can help readers of the financial statements make informed decisions about your financial performance and why it might differ from expectations. So the accounting equation, this is something that if any of you have ever taken an introductory accounting class, this is probably the very first thing you learned. Assets equals liabilities plus equity. And basically there are a few different ways to interpret this. A lot of times people ask when they first learn this, why isn't it assets minus liabilities equals equity? Because that kind of makes more sense before you really learn about accounting. But there are a few different ways I like to think of it. Really, and I think the way that makes the most sense is that liabilities and equity are essentially how you fund your assets. So assets are what the company has. It's all your cash, maybe your inventory, your receivables, all the things you have that either are cash or can be converted to cash in the future. Liabilities are what you owe. So it's what you owe your vendors. It's what you've purchased on credit, things like that, things that are going to require cash outflows in the future. And your equity, while it is the difference between your assets and your liabilities, it's essentially all the other types of ways that you've been able to fund your assets outside of taking on debt. So whether it be money from investors or your accumulated earnings in the business, that's what equity represents. So when you're looking at a balance sheet, again, the reason why the formula is kind of written like this is because a company's balance sheet is divided into two parts. The first part is your assets, and the second part is your liabilities and equity. And the two halves have to equal out. So your liabilities and your equity have to equal your assets, or else something is missing on your balance sheet. And the other way to think of it is when you're talking about debits and credits, again, it's introductory accounting language. And we'll talk about that a little bit later, but assets are typically presented as debits and liabilities and equity are typically presented as credit. So again, it's like that two halves thing, assets are on the left as debits, liabilities and equity on the right as credits, and the two sides always have to equal out. And one practical example, just to kind of maybe help you understand the equation a little bit better. When you're purchasing a home, typically you're funding part of it yourself with a down payment, and then you're taking on a mortgage for the rest of it. So the home is your asset. When you make that purchase, that's what you have. And then you funded it in two different ways. You took on a mortgage, which is your liability, your debt, that's what you owe. And then the rest of it essentially represents your equity. So that's one of many practical examples of how the accounting equation can be applied. The different elements of accounting. So assets and liabilities for really any type of business are pretty much the same in concept, and the accounting for them is the same. Equity can be a little bit different depending on what type of organization you are. So typically the two most common types of organizations you're going to hear about are either LLCs or corporations. And there are a variety of considerations that go into which one of those you want to organize as. But for a partnership, for example, the equity part of the balance sheet is normally referred to as something like members' equity or partners' equity, and it's typically just presented as a single amount. Whereas for a corporation, it gets a little more complicated. Because for a corporation, on the equity part of your balance sheet, you normally see a few different types of accounts. You'll see an account called common stock, and maybe an account called preferred stock if you have preferred stock. And essentially all that represents is just the par value of the stock that the company has outstanding. So that's typically very small, especially for a startup, because par values are normally no more than $1 per share, or sometimes even smaller. And the main account you'll see in the equity part of a balance sheet for a corporation is something called additional paid-in capital, which represents the excess of all the investments you've received over par value. So for example, if you issue 100 shares with a par value of $1 per share, but you issued them at $5 per share, your common stock account would be $100. Your additional paid-in capital account would be $400. And then your cash obviously would be $500. So again, the debits equaling the credits all the time. And then the third type of account you'll typically see in a corporation's equity part of the balance sheet is something called retained earnings, which represents the accumulated earnings over however many years the company's been in business. And if it's positive, it'll be called retained earnings. If it's negative, which it commonly is for a startup because you're losing money in the beginning, would be called something like accumulated deficit. All right, types of financing. Again, it's either debt or equity, liabilities or equity. These are the two ways that you fund your business and you come up with assets. And another term you'll commonly hear when you're in the financing world is dilutive or non-dilutive. Dilutive types of financing mean that it affects the overall ownership in the business. So a dilutive type of financing is typically, that means equity. It means you're issuing additional equity, which means existing owners' share in the business will likely go down as a result of the financing because you're bringing new people into the business. Whereas non-dilutive financing typically represents debt. So it's another way to raise money without affecting ownership. And I'm sure you've all pretty much heard of each of these types of financing. There's nothing too fancy here. Obviously, there are many other ways to raise money, but these are common examples. Debt, credit cards, obviously just basic purchasing things on credit. That's a liability. Lines of credit, commonly taken with banks. And the thing to know about that, or any type of loan from a bank, is that many times they will often require financial statements as a result. So that's one thing to keep in mind when you're taking out loans from financial institutions. Oftentimes they will require that you give them probably annual financial statements that may need to be reviewed or audited by an independent CPA firm. So another reason why things like this require strong accounting systems to be in place, because you can't do that without a good accounting system. And essentially lines of credits just allow you to borrow up to a certain stated amount that the bank will set for you. And it may also come with certain covenants, which again, we'll talk about later when we talk about ratios, but a common line of credit or bank loan covenant would be to maintain certain minimum financial statement ratios, which again is another reason why financial statements would be required. So we'll talk about some of those common ratios and how they're used and how they're calculated. But it's essentially a way for the bank to really protect themselves and make sure that they're comfortable with continuing to loan the business money. Loans typically obviously require regular principal and interest payments. So that's another thing to keep in mind. Make sure you're paying close attention to the terms of any loan or line of credit you're taking out. But most startups will start out really by just getting funding personally from the founders. That's typically what we see before the bigger stuff starts to happen. Convertible debt, the reason why that's in both columns is because convertible debt can be either non-dilutive or dilutive depending on what happens. So basically convertible debt is something that starts out as debt, somebody's loaning you money, but the lender has the option of converting their debt into equity in the business. So you may not have to repay that debt if they decide to convert it into ownership. But again, the thing to consider there is the fact that that's going to dilute existing owners' shares in the business if that exercise were to happen. But convertible debt is a very common source of financing for a startup because normally the expectation in our experience is that conversion will happen. So they feel like it's a good way to finance because they don't expect to actually have to repay any money in the future. Other financing options, grants, and this is something I mentioned at the very beginning, government grants. This is something I feel like we're seeing a lot more of lately. We're seeing a lot of startups seek federal grant money, especially when it comes to things like medical type research, biotech research, other research and development areas. So we're seeing that a lot lately. And while that's certainly a good source of financing, one thing that really should be stressed is that if you do end up taking a large amount of government money, you really need to make sure you have a very strong and very detailed accounting system and that you're tracking your expenses very closely, because there's a law that says that if you expend more than $750,000 of federal grant money during a year, you have to have what's called a compliance audit, which is a very involved audit of all those expenses to make sure that they were incurred for appropriate purposes. And basically that, your overhead is within what it was supposed to be. And that all that has to be done by independent accountants. So there's a significant cost to that. There's a significant time requirement for that, and you have to have the necessary information and documentation on hand to be able to get through that type of audit. So it's definitely something to be aware of and make sure you plan for before you get into that world. Crowdfunding, we've seen a couple clients do that. Depending on the amount of money you're going for, that may also require financial statements reviewed or audited by an independent accountant. So again, another example of why, as you grow, accounting becomes very important. And types of stock, briefly mentioned before: common stock, preferred stock. Common stock is the basic type of stock. Preferred stock is stock that comes with certain special rights. And those rights are basically determined by, your articles of incorporation, your stock purchase agreements, your bylaws. It's up to the company, but common types of preferred rights might be certain liquidation rights. If the company were to sell or liquidate, the preferred shareholders might get the first crack at any liquidation proceeds. Additional voting rights are another example. Priority on dividends or priority on any future stock issuances. Those are all types of examples of preferred shareholder rights. So more into the accounting basics, which again, I know it's the most exciting topic on here, but it's good to know when you're getting into this world. So the basics of journal entries are the debits and the credits. So I mentioned before how, assets are typically presented as debits, liabilities and equity are typically presented as credits. So when you're making let's talk about that home purchase again. So you bought a home, let's say for $100,000, you made a down payment of $20,000, you took on a mortgage of $80,000. So the entry there, the home is your asset. So if you're increasing an asset by 100,000, you're debiting it. So you would debit a home asset for $100,000. The mortgage is your liability. It's what you owe. So you would credit a mortgage liability for $80,000. And then the down payment is what you actually paid in cash. So cash is an asset. So the down payment is a reduction of an asset. So you would credit your cash asset for $20,000. So you have a debit of 100,000 and you have two credits, one for 80, one for 20. So your debits and credits equal, as they always should. And that's an example of a journal entry. So when you're increasing an asset, it's a debit. When you're reducing an asset, it's a credit, and vice versa with the liabilities and equity. When you're increasing a liability, it's a credit. When you're reducing a liability, it's a debit. Charts of accounts. So this is very important when you're first setting up your accounting system. Basically what a chart of accounts is, it's literally the listing of all the accounts in your system and the related account numbers. So best practice when you're coming up with your chart of accounts is to make sure all of your assets, start with the same number. Like you could have all of your assets starting with the number 1 and have like cash be account 100, accounts receivable be account 110, inventory be account 120, so on and so forth. And then liabilities start with the number 2, equity start with the number 3, and then revenues, once you get into the income statement, revenues is number 4, expenses is number 5. So it's important to have a very organized chart of accounts so that you can clearly tell, what are my assets, what are my liabilities, what are my equity. It makes it a lot easier to do things that way. And assets versus expenses. We'll talk about this a little bit later too, but this essentially relates to what your capitalization policy is. So when you're purchasing pieces of equipment, whether it be a computer or something larger, anything that might be considered an asset, it's important to have a policy in place to determine whether that purchase should represent a purchase of an asset or whether it should just be written off as an expense. And a company's capitalization policy essentially states anything I purchase that's over this dollar threshold will be called an asset on the balance sheet. Anything under that will be called an expense. For tax purposes, that threshold is $2,500. So for example, if you buy a computer for $2,000 for tax purposes, you can expense that. If it's over $2,500, you would have to call it an asset and depreciate it over time. For larger companies that have audited financial statements, that threshold can be as high as $5,000, but it's something that should be set by the company and followed consistently. And that naturally takes us into accounting policy. So you can see capitalization policy on this list. So that's one example of an accounting policy. There are many others. And this list is certainly not exhaustive, but it's a good starter list. Basis of accounting, very important. So there are a few different types of basis of accounting out there that can be used for different purposes. But the main one to be aware of is GAAP, or generally accepted accounting principles. GAAP is the standard when it comes to basis of accounting. It's what any large financial institution or investor is going to want to require. When you get to that point and when they start requiring financial statements, they will almost certainly require GAAP financial statements. It's the most complex basis of accounting, obviously, but it's also the most reflective of the true financial position of the business. We'll talk a little bit more about the details of that in a bit. But there's also cash basis of accounting or tax basis of accounting, which are both more simple, but are not as comprehensive and are not as reflective of truly what's going on. But it's easier to maintain and easier to keep track of. So there can be advantages to those as well. Cash accounting policies, really what matters here is when you're talking about, short-term, highly liquid investments, are you considering those cash or are you considering those separate investment assets? So typically what you might see on a financial statement is something like, we consider anything with a maturity of 3 months or less to be cash, anything longer to be investments. Fair value, whether you want to account for an asset at cost or fair value, there are certain assets that are supposed to be measured at fair value. Again, the most common example being investments. So you just have to make sure you're aware of how you're valuing it. Normally for a startup, it's easy because you're not doing anything too crazy. It's probably just whatever. If you own stock, it's whatever the stock is quoted at. But it's important, again, in financial statements to disclose how you're measuring fair value. Allowance for doubtful accounts. So when you have receivables from customers, eventually you might get to a point where it's no longer, guaranteed that you're going to collect every single receivable from your customers. Some customers might not be as good at paying. Some customers might not be in a great financial position. So it becomes important to estimate what portion of your receivables may not be collectible. And there are various ways a company can go about estimating this, but essentially that estimate goes as a reduction of your receivables and as an expense called bad debt expense. And it's an estimate that can be adjusted over time as circumstances change. But it's important, again, in financial statements to disclose how you're estimating that. It can be a certain percentage of your receivables, it can be a certain percentage of your revenues, or it can be a line by line study of your individual receivables to see, what this one, and just pick out which ones you feel like might not be collectible. Inventory costing, it's not something we see apply too much to young startups, so I won't spend too much time on this, but essentially it's just a measurement of how you're measuring your inventory. You might have heard of the terms like first in, first out, or last in, first out. So companies that have large amounts of inventory, they don't have the necessary time or information to value each individual item of inventory by itself. So they come up with certain estimates to determine what their total inventory is. Depreciation methods, much more practical for this type of conversation. So for assets for items that you purchase that you capitalize, meaning you call them assets. So like that computer that was over $2,500, you have to call it an asset and depreciate it over time as an expense instead of calling it an expense right away. And there are different depreciation methods out there for calculating that over time depreciation. The most common is simple straight line. So if it has a life of 5 years, you would divide the total cost by 5 and depreciate that much each year. For tax purposes, depreciation is calculated on a more accelerated basis, meaning more depreciation is taken in the early years and less in the later years. But for financial statements, you typically see straight line. And lease accounting is it's pretty much beyond the scope of this because it can get quite complex. But the key thing to keep in mind is that the accounting standards have recently changed, and it's actually just happening now for 2022. So when you get into the GAAP financial statement world, that's definitely something you'll want to consult with a CPA about, because the accounting can get quite complex. But essentially anything you lease almost is going to end up going on the balance sheet as well as assets and liabilities. Asset for, you know, the thing you're leasing, and liability for the lease payments that are going to be owed in the future. All right, back to basis of accounting. So GAAP is an accrual basis of accounting. Accrual basis of accounting means that you recognize revenues as they're earned, and you recognize expenses as they are incurred. So it's not as simple as cash basis, where you recognize revenues when you collect money and you recognize expenses when you pay money. Accrual basis actually requires you to understand, you know, when certain things occurred. So you would recognize a service revenue when you perform the service, even if the collection is to come later. And you would recognize an expense for a service when that service was incurred as well. So for example, if you get a bill from your attorney in January that says this is for services performed up through December 31st, then that expense has to be recognized in December, not January. So that's a common slip up an accountant might see when they're looking at a small company's books. They would say, okay, you have to recognize this expense this past year, not in the next year. And the matching of revenues and expenses is a key concept when it comes to the accrual basis of accounting, because for the most part, you know, revenues will have related expenses. So you might have heard the term cost of sales before. So whenever you perform a service or sell a product, there's normally some cost associated with it, whether it's the cost of the product you sold or the time of the people involved in performing the service. So it's always important to keep in mind that, again, when certain events occur, there's likely going to be some sort of revenue and expense to recognize at that time. And that's also where receivables and payables come into play on the balance sheet. So again, if you perform a service in December, but you don't receive payment until January, in December, you're going to have revenue and you're going to have an accounts receivable from your customer. I see someone looks like they raised their hand. Is there a question? We can go over it at the end if.
I don't see any raised hands.
Okay, well, if anybody has questions, we can certainly talk about them at the end if that's best. So
yeah, you can also try submitting them in writing, or I'm sorry, I just don't see anybody with a raised hand.
No problem. Maybe it was an accident. All right, so accrual versus cash, advantages, disadvantages. So the advantages of accrual basis, again, are that when you get into larger investments, that is what's going to be required more often than not. So it's important to have an accounting system in place that can facilitate that. And a very good example that we use for almost all our clients is QuickBooks or QuickBooks Online. QuickBooks is very good with accrual and cash. If you set it up correctly, then it allows you to flip back and forth between the two, depending on whatever your purposes are. So again, that's the main advantage of accrual, is that eventually it's going to be required. And again, it's the most reflective of your true financial position. It reflects everything that's actually occurred, not just what's changed hands. The disadvantages being that it's complex. It takes time. It takes time to understand. It likely requires the help of an outside accountant. So there's cost involved in there. So it's something to do when it's necessary, but it may not be appropriate right away. And then the cash basis is pretty much the opposite. It's very easy. It's very simple. It is an accurate reflection of your burn rate. It's an accurate reflection of what you actually have on hand to pay upcoming expenses. So obviously it is important to track cash, and cash basis will help you with that, especially at the very beginning stages. But again, the disadvantage is being that it's not going to be as long as you keep growing, eventually that's not going to be enough. So on to financial statements. So 4 types of basic financial statements. The first one's the balance sheet. We talked about this one. This shows your assets, your liabilities, and your equity. You'll also see profit and loss statement, or P&L, or income statement, or statement of operations. It can be called a few different things, but the most common term I hear is P&L. It reflects the results of your operations during a given period. So it's basically your revenues and your expenses, your net income, your net profit. That's what the profit and loss statement shows. A statement of retained earnings is something that can be combined with a P&L if it's simple enough, or it can be its own statement, like it commonly is for a corporation, because again, corporations have more equity accounts. But the statement of retained earnings is really like your statement of changes in equity. It shows how you got from your beginning equity to your ending equity. And we'll talk in a little bit about how that flows. And the last one's called a statement of cash flows. It's the most complicated to prepare, but it's very important because it tracks the change in cash from beginning to year and end of year and everything that went into that. So a little closer look at the balance sheet. So these are the most common types of assets that you would see. Cash is obvious. That's everybody's first asset, how much cash you have. Accounts receivable, what you are owed from your customers. Investments are, we kind of talked about this too, longer term investments, like maybe stock investments or investments in other companies that don't have stock, but any sort of money that you've put into some other sort of business, and that's not as quickly convertible into cash as something as simple as like a T-bill. Inventory, it's what you have that you're selling. So if you're selling a physical product to customers, if that's your business, then inventory are the items you have on hand to sell to customers. Prepaid expenses are expenses that you pay for in advance. So this is an account you would only see if you were on the accrual basis of accounting, just kind of like accounts receivable is. So for a common example is like prepaid insurance. So if you pay for 2022 insurance coverage at the end of 2021, that's an asset until that coverage period starts to occur. So it would start out as an asset and then periodically move into the income statement as an expense throughout the coverage period. Equipment, these are like your fixed assets, equipment, furniture, stuff like that. So longer term assets that you purchase that are above that capitalization threshold. Those are your fixed assets, and that's what's being depreciated over time. Patents, trademarks, copyrights, these are all examples of intangible assets. So similar to fixed assets, these are being depreciated, or in the case of an intangible asset, amortized over time as an expense. So, anything of value to the business that isn't actually a physical thing. So that's why they're called intangibles. And notes receivable are kind of like accounts receivable, but longer term. You're receiving payments over time, over a number of years. So it's basically like the opposite of a mortgage. You're the one receiving it. So if you have a mortgage payable, the mortgage company would have a mortgage or note receivable. So that's basically the other side of it. Another thing to keep in mind, and this is important when it comes to financial statement ratios, which again we'll get to at the end. But when you're looking at assets or liabilities, there's the current or non-current concept. So a current asset is an asset that you expect to convert to cash within 1 year. So common current assets would be cash, receivables, prepaids. Non-current assets are assets that are not expected to be liquidated within 1 year. So it's the opposite of current. Common non-current assets are your fixed assets, your depreciated items, or your notes receivable that aren't going to be collected within 1 year. Liabilities, so accounts payable, it's the opposite of accounts receivable. Accounts payable are what you owe your vendors. Accrued expenses are kind of the opposite of prepaid expenses. So an accrued expense is an expense that you've incurred but haven't paid for yet. a common example is like that legal bill example I talked about. So if you incur legal services in December, but you don't pay for them until January, that's an accrued expense at the end of December. Deferred revenue is when you collect money from customers in advance of you actually performing your service for them or giving your product to them. So a common example of deferred revenue is subscriptions. So if you offer a subscription service and the customer pays for it in advance, you have to put that as a liability, and you don't recognize the revenue until the subscription period starts to occur. And then lines of credit, notes payable. This is kind of what we talked about earlier, the different types of loans that you can get from banks. So these are longer term, normally liabilities. And again, current or non-current or long-term, same thing with liabilities. A current liability is something you expect to pay within a year. Long-term is something you expect to pay after 1 year. Equity. So again, it can be called different things depending on what type of business you have. But here's how it's basically calculated. So equity will increase or decrease depending on whether you get money for investors or whether you repay investors. So it would increase for contributions and for stock issuances. It would decrease for dividends or distributions to partners. It's increased by your net profit or reduced by your net loss during the period. So that's what flows into your retained earnings. So we talked earlier about how retained earnings is your accumulated earnings or losses in the business. And again, if your equity is negative, it would be called something like accumulated deficit or stockholders deficiency, something like that. All right, back and then balance sheet, just as an overall look. So a balance sheet is a snapshot statement, meaning that it presents something at your position at one specific date. So a balance sheet as of December 31st, 2021 represents your assets, liabilities, and equity on that day. And this is an example of what a balance sheet looks like. So you can see how you have your assets on the left side separated between current at the top and non-current at the bottom left. And you can see the same thing on the right side, your liabilities, current, and then the note payable, which is long-term, and then your equity. So assets on the left, liabilities and equity on the right. Your assets equals your liabilities plus equity. Your profit and loss statement, or your P&L, is a periodic statement. It shows your results of the operations over a period of time. So unlike a balance sheet, a profit and loss statement is something that shows your results over a period of time, not just one day. And basically, it's your revenues and your expenses that you net together and come up with your net income or your net loss. That's what the profit and loss statement is showing. Your revenues are obviously the income you generate through your operations, what you sell, the services you provide. It's how you earn your money. It's what you do. It's what the business is meant for. Your cost of sales are costs that are directly related to your revenues. So again, if you sell a physical product, your cost of sale is likely going to be the cost of the product to you when you purchased it or when you manufactured it. For services, it can be a little more tricky to figure out, but commonly it can be, the time or the salary of the individuals directly involved in performing the services. Sometimes you may not have cost of sales at all. Sometimes it's too difficult to figure out what directly relates to your sales. So it can be tricky for service providers or software as a service providers. So we've seen that. But normally it's some sort of estimate of time. And then a big part of the income statement are all your operating expenses. So your salaries, your rent, your utilities, any other type of regular expense that's involved and required just to run the business. Advertising is an example. There are plenty of examples, training, travel, all that stuff. And then your other income and expenses are things that are sort of, ancillary to running the business, not directly involved in your operations, but still, something that occurred and has to be recognized. Most common example being interest. So interest income or interest expense is something that would be separated and called an other item. So it's below your operating income or your operating loss. It's considered a non-operating item. So you might hear the term like above the line or below the line. So interest is something that's below the line. It's below your operating income. It's not included in that calculation, but it's still part of your net income or net loss. The statement of retained earnings. So again, this basically is reconciling your beginning retained earnings to your ending retained earnings, your beginning equity to your ending equity as a result of the net income you earned during the year, and then any other contributions or distributions from or to owners. And as I said, it can be combined with your income statement at the end after you calculate your net income, or if it's more complicated, like it normally is for a corporation, it can be presented as a separate statement. So this is an example of a combined statement of income and retained earnings. So you can see how you start with your revenue, subtract your cost of sales to get to your gross profit, then subtract your operating expenses to get to your operating income. Then you have your other items to get to your income before taxes. So if in the case of a profit, you may owe tax. So then you would subtract your income tax expense at the very end to get to your net income. And then they say, okay, that's my net income. This was my beginning equity, my beginning accumulated deficit. So I'll add my net income to that. I'll reduce for any distributions to owners to get to my ending retained earnings. The statement of cash flows, as I mentioned before. So this is what's reconciling your beginning cash to your ending cash from beginning of year to end of the year and everything that goes into that. And again, this is the most complex to prepare. It can be very tricky, and even more tricky the larger you get. But essentially, the key thing to keep in mind when you're preparing a statement of cash flows is that you have 3 categories. There's also 2 methods of preparing a statement of cash flow, but we'll concern ourselves with the indirect method because that's what 98% of companies use, the indirect method. So under the indirect method, your statement of cash flows is divided into 3 categories: operating activities, investing activities, and financing activities. Your operating section always starts with your net income or net loss. Net income or net loss is always the first thing on a statement of cash flows. It's your starting point. So you're reconciling your net income to your operating cash flow, essentially. And the main thing you'll see in the operating section first are adjustments for non-cash income or expenses. So a common example is depreciation expense. You would add depreciation expense back to your net income in order to get to cash flow because depreciation is not a cash expense. And the other things you'll commonly see in the operating section are the changes in your current asset and current liability accounts, right? So if your accounts receivable went down from beginning of year to end of year, that means you collected money from customers that wasn't included in your net income because it was already included in your net income when you recorded the receivable in the first place. So if your receivable went down, that's an additional cash inflow. It's an additional add back to net income. And it would be the opposite if your accounts receivable went up. If your accounts receivable went up, that means you recorded some revenue that wasn't actually collected. So then that you would reduce cash for that. And it's the same thing for all current assets and current liabilities. You would adjust for the change from one year to the next. Investing and financing activities are a little more straightforward. Investing activities represent transactions involving long-term assets. So if you purchase a piece of equipment, that's a cash outflow that wasn't included in net income because you capitalized it. Similarly, a sale of an asset would be a cash inflow from investing activities. Financing activities are transactions involving long-term liabilities and equity. So distributions to shareholders are a financing activity. Proceeds from loans, from bank loans are financing activities. Repayments on bank loans are financing activities. So those are examples of each of those categories. Obviously, as we talked about when we were talking about cash basis of accounting, it is very important to track cash flow. So that's why this statement is important. Net income is important in its own way, but it's also very important to see what's actually happening from a cash perspective, because you obviously need cash to pay your expenses that are coming up. So, investors and lenders are going to want to see what your cash flow is like from year to year. And again, this is an example of what a statement of cash flows looks like. So again, you can see you're starting with your operating activities, which starts with net income. We're adding back depreciation expense. We're reducing a gain on disposal. So just like adding back non-cash expenses, you also have to reduce net income for non-cash revenues. So a gain on disposal of an investment is basically means you sold it for more than it cost. So that difference is something that goes into net income, but it's not actually cash. And then this is obviously a very simple example, because cash flow statements can get really long and something that I don't think anybody desires to see at this moment. So this is a very summarized view of what a statement of cash flows looks like. And obviously you want to make sure that your ending cash at the bottom agrees with the cash that's actually on your balance sheet.
We have a few questions if you'd like
Sure.
to take a pause here. So the first one, and thank you. So the first one is, hi Joe, how are patents typically valued for a financial statement? It's a great question.
Yes, that is a great question. And it's something that can get complex when you're getting into it. But really what the cost represents that's going on your balance sheet is basically the sum of all of the related likely legal expenses that were incurred in developing the application and getting it ready for issuance. So what we often work with on our clients on stuff like this is we want to make sure that you are closely tracking when you get periodic legal bills. We want to make sure you're closely tracking, which expenses relate to which patent application, so that we can closely track what should actually go on the balance sheet as a patent asset. And when it ultimately gets issued, we want to make sure we know what the total cost is so that we can amortize it properly. So it represents most likely your legal expenses involved in developing the patent. And I would just say it's very important to closely review those invoices to make sure you're tracking and allocating the costs properly to each individual patent application.
Thank you. And then the next question is, I would also love to hear about what mechanisms a startup company would put in place to start doing accounting.
Yeah, the first step is to pick a software. So as I mentioned earlier, I think QuickBooks or QuickBooks Online, which QuickBooks Online is probably the most popular one right now, just because it's cloud-based and that's where we're all going. I would say that's the most important first decision to make. So QuickBooks Online is very good for small businesses and startups. It's probably the software that 99% of our smaller clients use. So we're very familiar with it. A lot of outside accounting firms are very familiar with it. But yeah, it's important to get that set up once you're at a point where you feel like you need to start tracking things more closely. And when you're setting it up, that's where you can create your chart of accounts there. And you can link QuickBooks Online to your bank account. So you can set it up in such a way that common recurring transactions will automatically get recorded into your accounting system as they hit your bank. So it can help reduce some of the manual work from that perspective. And you can generate financial statements from QuickBooks. You can generate all kinds of reconciliation reports from QuickBooks. You can set up budgets in QuickBooks and produce budget to actual reports. So you can do all kinds of things on there that or in case you don't know how to do that stuff, any outside accountant could help you with implementing properly. So I would say that's the very first most important choice to make. And again, if you set it up properly, you can flip back and forth between accrual basis and cash basis too.
And there's a follow-up question. Do we need an accountant from the get-go to start doing accounting in QuickBooks, or should we wait until it gets serious?
It's a very good question. I would say if you feel like you're able to set it up properly and at least get the basics done, like linking to your bank statement and producing basic reports, I would say probably, stick with that until you're at a point where it's just getting to be too much and you feel like maybe, you're missing things here and there and you're not fully accounting for all the transactions that are happening. There definitely comes a point where you need accounting help, and whether that be somebody you hire internally or an outsourced accounting firm that you utilize. I would say there definitely comes a point, and I would just say it's probably more of a feel thing than anything else. If you feel like you're handling things and you're not using up key people's time with things that they would rather not be doing because that's not what they're supposed to be doing and they want to focus more on the bigger picture stuff, then I would say that's probably the time when you start looking for some outside help.
Thank you. So there is also a comment saying that I thought this would be way over my head, but I absorbed quite a bit. Thank you.
That's good. I'm glad to hear that. Maybe I'm not making it tough enough. Maybe that's my fault.
Thank you. And another question, do we need a CPA to guide us so that we are accounting for all necessary elements?
As a CPA myself, I would of course say yes, right? I would kind of give a similar answer to what I gave the last question. If you feel like you're at a point where it's becoming to be too much, if it's taking too much time and you're just not comfortable with what you're able to do on your own, then I would say naturally, yes, there does come a point where you need somebody who specializes in that sort of thing. Again, it can be somebody you hire yourself, or it can be, a firm that you use to help you out.
Yeah, thank you.
No problem. And I think we're in the last part here, so hopefully not too much more time because I know we're running a little bit close. The financial statement ratios. So I've referenced this kind of throughout the presentation. So, when you take out loans or when you have big investors and they're looking at your financial statements, they may be calculating certain ratios based on what you're showing to kind of give themselves a certain idea of, how things are at the company, what the financial position is. Which ratios are used, it depends. Again, if you have a bank loan, then the loan agreement might actually have a section called covenants that actually say, you need to maintain a current ratio of at least 1, or a debt service coverage ratio of at least 1.25, something like that. So we'll talk about some of those ratios here and what they mean and how they're calculated, so you kind of know what they're getting at. Working capital is current assets minus current liabilities, and current ratio is current assets divided by current liabilities. It's essentially a measure of your short-term financial position. So we talked earlier about what current means. It means anything that's a current asset is anything that can be liquidated within a year. A current liability is anything that's going to be paid within a year. So these ratios basically represent your ability to pay off your liabilities within 1 year. Do you have the necessary assets to get that done? Debt to equity ratio is essentially a measure of your overall leverage. How are you funding your assets? So remember, liabilities and equity are the two methods of funding your assets. So it's essentially a measure of, how aggressive is a company in utilizing debt versus equity. So any lender would probably consider a higher debt to equity ratio to be riskier because it means you have a lot of other debt. Whereas if you finance primarily by equity, you'd probably be considered lower risk to a lender. Debt service coverage ratio, I briefly mentioned this one. This one's common. So this essentially represents the amount of cash you have on hand to be able to meet longer term debt. So the debt service coverage ratio can be calculated in several different ways, but this is essentially the basic version of it. It's a measure of net income divided by your annual debt service payments that are required, your principal and interest payments. And this is where the term EBITDA, or some people say EBITDA, so EBITDA, this is where that term can often come into play, because normally with a debt service coverage ratio, the top line isn't just going to be net income. It's going to be something like this. It's going to be net income before all the stuff that isn't really important because it doesn't represent cash or it doesn't represent your main operations. So a lot of lenders will say, okay, when we calculate debt service coverage ratio, we'll take away your interest expense, your tax expense, your depreciation and amortization expense, because that's not a true measure of the cash you have on hand or your main operations. It'll also take away interest income, though, just as an FYI, but mainly it's something that helps. It's something that's going to increase your net income for purposes of, purely for purposes of making this calculation, to make sure you're in accordance with the covenants. And that's pretty much it. That's all I got to say. So for the rest of our time, if anybody else has any other questions, here's my information. Cheryl's my boss. She comes to these sometimes, so that's why I have her picture there. But yeah, she's our partner in charge of working with all the startups and emerging tech companies here. So she's a good name to know too.
Thank you so much, Joe. This has been fantastic and very helpful. If you have a few more minutes, we have 2 more questions.
Sure.
We have time. Thank you again. I hope that everybody got a lot out of this, and feel free to follow up with Joe. So the next question that we have is, you mentioned handling it yourself to get started. Does that also apply to the tax preparation, tax filing side of the accounting process?
When it comes to tax preparation, I mean, again, if you're really, really simple and you feel like you can do that through some sort of basic software, then sure, go for it. But that's something that can be more complex more quickly. I would always hesitate unless you feel like you have a good background knowledge of taxes and how to do it. I would definitely probably recommend getting help on that sooner rather than later, just because you of course want to be in line when it comes to stuff like that. You don't want to have to go back and amend returns if you realized you missed something later. So I would say that's a little more tricky to do on your own, probably, unless you're just super, super simple and hardly anything's going on in your business.
Yeah, I agree. Tax preparation can be difficult.
Yes, from all perspectives. Yeah.
The next question is a bit technical. Thank you for the presentation. Question on value of a patent on financial statements. What is if someone is willing to buy your patent for $1 million? Can you then depreciate at this market value versus the legal cost of getting a patent?
That's a very good question, and unfortunately, the answer is no. So, and but that's assuming you're under GAAP. So, GAAP is very conservative when it comes to stuff like that. There are certain things you can measure at fair value, commonly like investments in other businesses. But when it comes to stuff like property and intangible assets and receivables and other types of things, you're normally required to measure at cost, meaning you have to measure it at how much you paid for it and depreciate it over time. So when you're talking about a GAAP financial statement, no, you would not be able to do that, unfortunately. But of course, GAAP also says if your value is lower than your costs, yeah, you have to impair it and reduce it. So that's kind of what I mean when I say GAAP is conservative. It always leans towards the thing that may not make you look as good. That's what GAP's all about. They don't want to mislead people the wrong way.
Thank you. And one more question. I need clarification about the journal entry. If I, the owner, paid for items out of my own pocket, how would I record that in QuickBooks?
That is a good question. So yeah, if you, the owner, personally paid for something for the business, so meaning it didn't come out of the company's funds, then you would record that as a contribution. So it would be equity. So you would debit your asset and you would credit your equity. So it would be like you contributed money to the business.
All right, thank you. And then there was a question also, possible to get linked to the slides or to the recorded presentation. The presentation will be posted on our Startup UMD YouTube channel as soon as probably in a few days when the video is finished processing and we have time to upload it.
Great.
Oh, yeah, so great on timing and great questions. While I still have some folks here, if you wouldn't mind, I'm going to launch a quick survey, a quick poll. And while you are, the poll is anonymous, so please fill out to let us know how we are doing. And while you're filling out the poll, I would like to thank Joe Bishop for joining us today and sharing all this great information. Obviously, it's really difficult to teach the entire discipline of accounting in 1 hour, but
Yes.
but that wasn't the purpose of this presentation. The purpose was to hopefully get you a little bit better familiar, a little bit more familiar with the concepts and terminology, so that you can set up those first few records yourself, and then when you talk to your accountant, you understand a little bit better what he or she is asking you or telling you. So thank you so much, Joe. It has been great, and I can see that our poll numbers are coming in, and very positive, so thank you so much. And we might follow up again, so there's some interest in that poll indicating that people are interested in a follow-up, maybe some kind of more in-depth question or an updated version of this workshop in the future. So thank you so much, Joe.
No problem. Thank you. I appreciate it.
And the poll.